afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started with today's programming, a few quick reminders. Anyone who is registered for today's program will be receiving a copy by next week. And since this is a content-heavy presentation, lots of important information, if you have any questions, you'll find contact information for our presenters in the presentation, or you can send them to me and I will pass them along. Now, please join me in welcoming our friends from Moss Adams, Brittany Richards, Brianne Eagles, and Jonathan Gates. Thanks for joining us today, guys. I know you have a lot to get to, so I'm going to just let you take it away.
Great. Thank you, Rachel. So I am Brianne Eagles. I am a tax senior manager in our Pacific Northwest region. I'm going to be talking today a lot about the state pass-through entity tax elections and their benefits. Up next, we'll have Brittany Richards, who is also a tax senior manager in our Pacific Northwest region. She's going to be walking us through Public Law 86272, some changes to that and how it might impact dealers, and then also some residency planning considerations. We also have Jonathan Gates, who is in our senior manager in our Tangible Asset Incentives group, and he's going to give us some updates in the tangible asset incentive space. So I will start off by talking about these pass-through entity tax elections. So I'm going to talk about just an overview of what it is, why it's important, and the benefits that are available. So back in 2018, when the Tax Cuts and Jobs Act was first enacted, one of the provisions in that law was to reduce the state and local tax deductions that individuals were able to take on their individual return down to only $10,000. So compared to what was previously available, taxpayers who lived in high income tax states such as California, New York, New Jersey, they really really felt the loss of that deduction. It had a pretty big impact on them, to where some of the tax benefits that they should have gotten from the Tax Cuts and Jobs Act were washed out by the loss of this deduction. So states really got to work looking at alternatives and looking at different strategies to figure out a workaround to give their residents some type of benefit for the state taxes that they were paying. Lots of ideas were thrown around, but what they finally settled on was this pass-through entity tax regime. So at a really high level, what this is if you have a pass-through entity, so a partnership or an S corporation, and you're an owner of one of those entities, you are able to pay the state tax on the state income tax of that entity at the state tax or at the entity level. And what that does is then that deduction that's being applied at the entity level then flows through to the individual. So it's just a workaround, only really applies to business owners who have pass-through entities, but it can be pretty impactful. At this point, more than 30 states have passed this type of legislation or have some type of similar legislation pending currently. Some states were on top of it and had laws effective as of 2021. Many are 2022, and there's probably a few, there are a few late to the game that are 2023. But you can see how pretty much if you live in a state with income tax, you may benefit from this. So an example of this, just to illustrate how much benefit is potentially there, pass-through entity owners typically pay about 29.6% federal tax on their income. That is the top rate of 35%, reduced by the benefit of the qualified business income deduction. So it's down to an effective rate of about 29.6. So in this case, the pass-through entity has $5 million of state taxable income, and they're in a state that has a 10% tax rate. So that deduction, that tax being paid at the entity level, would be $500,000. And then the federal tax benefit would be that $500,000 times that 29.6% rate. So that federal tax benefit of $148,000 is actual federal tax dollars saved just by making this election and paying state tax a slightly different way. So you can see how it's very impactful, very beneficial for owners of pass-through entities. So this is brand new law. This is still evolving law that's changing pretty much constantly. So there, isn't one state we're going to talk about, and everything that I'm going to talk about is going to be dependent on which states you're looking at, which states you may have income in. But just keep in mind that there are lots of pieces to this. There are lots of considerations to make. And I'm going to try to point out the most important ones that we see as a pretty constant across all the states of just considerations that need to be made. So some really important things, obviously, the deadline for making the pass-through entity election. Is it, at the end of the year? Is it when the tax return is due? Is it the extended date of the tax return? When is the deadline for making the election? How is it made? Is it made by just doing, so just filing a tax return with those forms filled out, or is there some other process that has to be followed? Is the pass-through entity you have even eligible to make the election? So some entities may be disqualified per the specific state's laws, but I'd encourage with that one in particular, if you think you have an ineligible entity today, keep watching it, because it may have been unintended to exclude that type of entity, or the state could have gotten some pretty big pushback from its constituents to make some changes to allow that type of entity to make the election. So even if you think you don't qualify now, keep watching it. You'll need to understand whether all owners are eligible or if some may be excluded. Is an owner allowed to opt out? So do all owners have to participate, or do some owners have the option to opt out of making the election? And how is the pass-through entity determining the amount of tax to pay? How is it doing the calculation? Obviously, in my example, I used a very, very simple method, which some states, that's all it is, but there are some states, especially at multi-state income, there may be some differences that you need to think about. A couple other things to think about, how does the PTE owner get benefit from this? So are they getting a state tax credit flowing through to them directly, or is, like in my example, is that $5 million just being excluded from their state income? So it's being treated as previously taxed, and they don't ever have to report that income on their individual state tax return. Every state, like I said, has different rules. Well, most states also have different rules for their corporations versus their individuals. So, under this new PTE tax regime, is income being calculated slightly differently at the entity level as it typically would have at the individual level. Guaranteed payments are another big consideration. If you have a partnership that pays out guaranteed payments to its owners, are those included in the pass-through entity income, or is it excluded? That could also have a pretty big impact on how beneficial making the election could be. Is this a whole new filing that has to be done by the pass-through entity, or has your state done some type of combined filing, consolidated filing that's maybe helping with compliance, or is this really upping your compliance requirements? Non-residents are probably the biggest complication in all of this. This is what where most of the work has to be done is around non-residents. But one potentially really good thing for a non-resident would be that if they're making the election at the entity level and they have no other income in that state, then maybe they don't have to file in that state any longer. Maybe they no longer have a filing requirement. So it could simplify compliance for a non-resident potentially. Make sure that you understand the estimated tax requirements and what the implications of not meeting those estimated tax requirements may be. Is it just if you're late or you're underpaid that you may have some underpayment penalties, which, most individuals are used to those coming into play here and there? Or is it something that if you miss a deadline or if you're underpaid, that you just can't make the election? California has a requirement like that in place, and that could completely exclude a pass-through entity from making the election. So make sure you just know what those are and know what the implications of them are. And then this is one, like I said, the states are still working on implementing some of these. So some of these laws aren't really passed or enacted until mid-year. So if you have been paying, your pass-through entity has been paying into a non-resident withholding account or some type of composite account, is there an ability to move what you've already paid this year over into a PTE account? That way, you're not having to double pay and take a refund later. And with that one, most of the states I've dealt with so far, that has not been an option, but it's definitely something to be aware of and, look into if you have that issue. So, like I said, the non-resident thing is probably the biggest thing. These, for states where these payments come through as credits to the individual, you really want to understand how those credits interact with other state tax credits. There are some cases where it may, reduce or eliminate the benefit of the election. So this is where, modeling comes into play, and it becomes really important for all of the owners. Is it going to benefit everyone? If it doesn't benefit everyone, is there anything that can be done? Like, I mentioned, is there an opt-out option, or do you just not make the election at all because of the loss of benefit to one owner? So that's where modeling really comes into play. For tiered structures, so you have an LLC that owns an LLC that owns an LLC that LLC is owned by lots of owners. You have to know where the tax is paid and who makes the election. Does each LLC make the election? Does the top LLC make the election and it just flows through? Each state has different approaches and different rules around that. So you just have to understand, if you do have a tiered structure, does it still work? How does it work? What do you need to do? Another really big consideration that I'll talk about a little bit later is when the deduction can actually be made. Is it when it's paid? Is it when it's due? That type of thing. Just understanding when you actually get the benefit of the deduction. And then also net operating losses. So if your pass-through entity is in a loss year, which has not been the case for most of our dealers the past several years, but could be in the future, we need to be aware of how it could impact it. Does that net operating loss stay at the entity level, or does it drop down to the individual level going forward? So this map just kind of gives you a visual of what states are participating, and this is probably not totally accurate, because like I said, it is ever evolving. I think all of this was up to date as of July of this year, so I'm sure there's been some little changes here and there, but it gives you a really good, just overall idea of how many states are participating. And then what this also shows is what I mentioned earlier, which states are doing the credit approach, so that the tax paid at the entity level comes through as a credit to the individual, versus the states who are treating it more as a income that's previously taxed at the entity level that never ends up flowing down to the individual. And this next map shows you these blue states are the states that basically everyone has to participate. It's all eligible owners are in there, versus the orange states, which are only consenting. So the California here is a great example of that. Only consenting owners can do it. Everybody has to sign on to it. So as I mentioned a minute ago, not everyone's going to benefit. Those other state tax credits can have a huge implication on whether or not you want to go forward with it. For partnerships, if you are in a state where partners have the ability to opt out or ineligible owners are excluded, you want to make sure that your operating agreement is current and allows for special allocations. Just make sure that you don't need an amendment to your operating agreement to allow that. And then another really important consideration for S corporations is that if you are in a state where ineligible owners can opt out or consenting owners can opt out, there is a concern that you could be implying that there's a second class of stock. So that the owners who are participating are in have one class of stock and the other ones have a different class of stock. So at this point, a general consensus is that if you have an S corporation, you do not want to have owners opting out or not participating for fear of, putting your S election in jeopardy. Excuse me. And finally, the timing of the deduction. So the states are relying on a notice that the IRS published that does indicate that whether you're a cash basis taxpayer or you're an accrual basis taxpayer, that the deduction is that state tax paid is going to be deductible in the year it is actually paid. So this is a little foreign to those who maybe are used to accruing some tax and being able to deduct it back in the not making the payment until the following year, but it's accrued back to the previous year. This is one where it does not appear to be the case. The guidance available now all indicates it has to be paid in the year. So if you're in a state that you're going to be making the election for 2022 and you want that deduction in 2022, that payment has to be made prior to the end of the year. And now I'm going to pass it along to Brittany, who's going to talk about Public Law 86272.
Awesome. Thanks, Brianne. We're going to shift gears for just a bit here and chat through some recent changes to Public Law 86272. For those of you that may not be familiar with what Public Law 86272 is, let's start with just a brief overview first. So this public law was enacted in 1959 and was really aimed at protecting sellers of tangible personal property from being subject to income taxes outside of their home state. So in order to have protection under 86272, the following conditions need to be met. So the only business activity within that non-resident state is purely sales solicitation of personal properties. Second one is any sales to the non-resident state need to be approved by the home office in the business resident state. And then the tangible personal property is shipped to the customer from outside that non-resident state as well. If all of these three conditions are met, then the business is deemed to basically be protected under this Public Law 86272 and would not be considered by that non-resident state as having income tax nexus in the state. 86272 is never really intended to be a permanent fix to income tax nexus generating activities of businesses in these non-resident states, but there's been no further legislation passed to date, so it's still in place today, with many companies relying on the protections available to limit their state income tax filing obligations. Now that we've had a quick recap on the history, let's talk through some of the recent developments that could potentially change the landscape pretty dramatically. So on August 4th of 2021, the Multi-State Tax Commission adopted a revised version of the Statement of Information concerning practices of Multi-State Tax Commission under 86272. It's really no surprise that with increase in sales across states through web-based platforms and just the prevalence these days of online purchasing, the primary update to this revised guidance specifically targets activities conducted via the internet. So under the new guidance, if a business interacts with a customer through that business website or an app of some sort, the business is engaged in activity within that customer's state, and therefore the business is no longer considered to be protected under 86272. But what does it really mean to interact with a customer? The MCT provided some additional clarification there. So let's take a quick look at what they've deemed to be considered okay and still protected under 86272, and then what activities are no longer protected. So if we can go to the next slide, thank you. The 3 activities that are still protected under 86272 are basically non-consumer specific. So posting a static FAQ, enabling cookies that basically, remind people that there's something in their shopping carts, offering tangible personal property for sale on just a searchable website. So all of those things are still okay. What they've really specifically stated as going above and beyond just the normal non-consumer specific are these additional items. And so I won't read through all of these here for time purposes, but anytime you start to specifically interact one-on-one with the end consumer, those activities now no longer provide you protection for 86272 purposes. At this point, many states are developing draft regulations to address the new guidance. At this point, the last time we did a check on this, New Jersey, Oregon, California, and New York are among the states that have provided draft guidance to taxpayers. While this change might not have as significant of an impact for our dealerships, it does in other industries, and for dealerships particularly with substantial parts and accessory sales online, or those dealerships that are close to bordering states, it will definitely be important to be aware of the new guidelines and to be proactively discussing that with your tax advisor, because it is unfortunately becoming easier and easier to create income tax nexus in those non-resident states without having a legitimate physical presence. So that's a little bit on the Public Law 86272. And then before I pass it along to Jonathan to talk through some of the tangible asset incentives, I did also want to walk through some residency planning considerations. So let's pivot here. And with so many changes to tax law and many varying on a state to state level, residency planning is really at the forefront of people's minds, especially for those of us living in the what we consider high tax burden states. So as we were getting ready for this presentation, we thought it'd be interesting to pull some data on what the highest and lowest tax burden states in 2022 are. And here's what we found. So here's a listing of the top 10 highest state and local tax burden jurisdictions. This does factor in income tax, estate tax, sales tax, and property tax. So they've analyzed all of these factors to determine the highest and lowest. I, for one, was a little surprised where I'm based out of Oregon, and I was for sure that Oregon would be amongst the highest, but it, as you see, did not make the list here. But no surprise, New York, California, they are our highest state burden tax list. And then let's take a quick peek at the lowest state and local tax burdens. So here's, the most popular states right now for people wanting to move to, if you will. Had a lot of questions from people about, Texas, Alaska, if you want to move to Alaska for tax purposes. But just thought this was a pretty interesting breakdown of the various states and where we're landing. So let's take a look at, as we're talking through residency planning considerations. I know this is probably a little hard to read, but I do think the slides will be available after the presentation. But it is important to, if you are considering a residency change, to really plan accordingly and do your due diligence. Oftentimes, especially with these higher tax burden states, they can be very aggressive on residency issues, and there's no necessarily what we call bright line test of determining residency. And so it is a very facts and circumstance driven process. And there are some safe harbors on days spent in different jurisdictions, but it really is where you build your life. Do you, are your doctors in this state? Where is your place of worship? Where is your cars registered? Where are your driver's licenses? So it's kind of building that fact pattern so that, in the event of a residency change, you have good supporting facts to support that change in residency. All right, with that, I will send it over to Jonathan, who will discuss a little bit on some of the tangible asset incentive opportunities to keep in mind as we approach year end.
Awesome, thank you, Brittany. Yeah, Jonathan Gates here. So tangible asset incentive services, obviously it's a mouthful and kind of encompasses quite a bit of stuff, but the main thing is fixed assets. And my goal today really is to kind of give you just a brief overview of what kind of opportunities are available to the fixed asset realm, and then obviously some big impacts that have happened recently in fixed assets, and what are some tax planning strategies that should be looked forward to, at least in the upcoming years. So the first one is kind of that big buzzword that most people would recognize, and that is cost segregation studies. So in a cost segregation study, for those who don't know what a cost segregation study is, it's basically a way to defer tax, right? It's a tax deferral strategy. It front loads depreciation deductions into the early years of owning an asset. The premise works on the basis of carving out short life property. So we will basically identify assets that qualify for 5, 7, 15 years, rather than the standard 27.5 or 39-year depreciable life. And in doing so, what that does is it increase cash flow, right? So it's dollars that are in your pocket today as a result of basically paying less taxes early on and owning an asset. We could be doing these studies for current year acquisitions and new constructions, but we can also do them for any kind of asset that was placed in the books previously. So looking back to assets that you may have acquired back in 2004 or 2005, as long as there's net tax value left in that asset, really it's a good opportunity to come in and look at it for a cost segregation study potential. Moving to the next slide here, basically start to list out some different types of studies that we do for cost segregation study. Like I mentioned, new constructions, but also remodels and expansions. These are huge, especially in the automotive dealership industry. Any kind of expansion or model or updates that are needed to kind of meet that new brand logo or that new brand motif for different kind of buildings. Tenant improvements are obviously another large one. For acquired property, we could look at things that might have been acquired through just a typical real estate transaction, but also in a like-kind exchange. As long as there's new basis in that new property or the boot's large enough to support it, cost segregation study could make sense. Some other very interesting opportunities are if you acquire a property that has multiple tax lots and might have multiple buildings on it, and for your own bookkeeping records and for dispositions later on in life, it's always nice to have those assets carved out separately and those buildings carved out separately, so you can identify them if there ever was a disposition to take place. And through a cost segregation study, we can basically accomplish that. I mentioned look back studies, so things you're actually going back in time and identifying assets that have been placed in the books in previous years. We'd file a 31-15 to accommodate that, and we basically catch up as much depreciation that it was allowed for that asset in the current year that we filed the 31-15. And the next biggest thing that really kind of helps, I think, hold a lot of benefit to a cost segregation study is that bonus depreciation. I'll cover that here in the next couple slides, but some good things to obviously keep in mind as you guys have projects that are going forward or projects that are in the books currently right now, or maybe some negotiations that are happening for acquired property, some important things to recognize and understand about bonus depreciation and what it's slated to do. So moving to the next slide here, we have some criteria that we like to see typically with a cost segregation study. The biggest one, obviously, we want to make sure that that taxpayer has taxable income and they can use the accelerated depreciation. Obviously, in our loss position, there's no need to create deductions, can't use them. However, it's a great tax planning strategy to start thinking about your NOLs and when are they about to start being used up, and to the point where you start becoming taxable. Planning and cost segregation study and when we can use these deductions, maybe with your NOL and your the NOLs as they start to phase out, could be a great strategy to make sure that you're continuing this NOL carry forward and you don't have a taxable year where you're getting bombarded with taxes. We'd like to see clients who own significant amount of buildings and land and improvements. And we, like I said, we can go back as far as we need to look at assets on their books. Once again, I mentioned expanding and remodel, big in the manufacturing required upgrade sector. Automotive dealerships obviously do a lot of this each year or each, every 5-10 years. So it's a great opportunity for a cost segregation study at that time. And then from a feasibility standpoint, we typically like to see the $1 million threshold being met for anything that's acquired or new constructed. Really, that's, again, it's just kind of a feasibility thing. What makes the most sense for the benefit that you'd get from a cost segregation study? That value drops though once we start getting into interior improvements. And the reason why it drops all the way down to what we say about $250,000 for feasibility is because of things that are allowed through special classifications in qualified property. There's qualified improvement properties, qualified leasehold improvement property. All of those types of property are eligible for bonus depreciation. And when we have something like 100% bonus depreciation, all that asset can be taken in that first year deduction. So that feasibility really kind of starts to make more sense at the lower dollar amount, right around the 250,000 range. So here's basically a table of the type of reclassifications of types of property that we typically see with a cost segregation study. As you can see, automotive dealerships kind of highlighted in blue down there, 25 to 45% in property that we would typically carve out. So if you could imagine $1 million facility and you do a cost segregation study, you could recognize anywhere from $250,000 to $450,000 in increased deductions in that first year. And tax effect of that obviously is cash back in your pocket and cash flow for you. And this next slide, I basically lay out an example for you to give you some real world dollar amounts to kind of get an eye on. In this example, we have a property, an automotive dealership that was purchased for $10 million. It's a 2019 property here that was placed in service in 2019. You can apply to current year as well, to 2022 to 2023, as long as we're holding that 100% bonus depreciation threshold there. You can see that the increased deductions that we're generating from doing the cost segregation study is right at $2.1 million. And the tax effect of that, right? So that's once you apply your tax effect to that 2.1, you get it to $782,000. That's cash that you would have been paying to Uncle Sam, and this is cash back in your pocket. A great opportunity for you to reinvest that amount. And then if you take that and you apply a 7% discount rate for net present value, is kind of how we value these cost segregation studies. That's $521,000 just by doing a cost segregation study. So here's a slide that I have on bonus depreciation, and this is really kind of boils down to, I think, some tax planning opportunities going forward, especially with how bonus depreciation is being slated now to start decreasing starting 2023 down to 80% and so on and so forth, all the way until 2027 when no bonus is available. I will say though, however, that bonus has been around for multiple years and for multiple reasons. 2001, 2002 with 9/11, it's a great way for the government and the IRS to kind of stimulate the economy, to bring back jobs back into the economy and stimulate growth. And so they have introduced bonus depreciation for multiple different reasons. So it's very unlikely to see that we would actually have a year in 2027 going forward where there would be no bonus depreciation. very possible that it could come back into play. But again, for those who have projects that are ongoing right now, or possible thoughts of projects that you want to, or properties that you want to acquire and you're kind of on the fence about, it's a good thing to kind of plan for that. In 1/1/2023, if we get an asset that's placed in service, then we're dropping immediately from 100% bonus, which is basically 100% of any asset that we carve out in a cost segregation study that's eligible for a shorter life can be deducted in that first year. Now in 2023, anything that we carve out that has a shorter life will be subject to 80% of that available for deductions in the first year, and the remaining 20 would have to be depreciated over its life. So some good opportunities right here for tax planning, obviously. The next thing I want to talk about is kind of probably the most impactful change that has happened in recent years to the tangible assets or the fixed asset realm, and that is the deductions available for energy efficient commercial buildings, what we call 179D deductions. And 179D has been around for a while now. Most people would recognize the opportunity, but essentially what 179D is, a little background on it, is if there's certain requirements that are met for an owner who constructs or builds a new property or improves a property with energy efficient building envelope or electrical systems and HVAC systems, as long as they're meeting a certain criteria, they could qualify for this 179D deduction. It's a deduction, it's not a credit. It has been extremely helpful and beneficial to people in the manufacturing sector and automotive dealership industry. And that $1.80 per square foot was kind of something that most people would recognize. And you would get basically $1.80 per square foot. If you can imagine, you have a 50,000 square foot building, you apply that $1.80 per square foot, that's your deduction that you're able to recognize. And it was adjusted for inflation going forward. In 2022, it went to $1.88. However, with IRA bill that was recently passed, the Inflation Reduction Act that President Biden put into act, there was a lot of changes that happened in this energy sector, a lot of different credits and incentives that were available. And one big one was the change to 179D. And that's what I want to talk about here. If you focus on the right-hand side of your screen here, you can kind of see some of these big changes that the IRA bill really set into action. And that is, they basically changed that percent or that dollar amount threshold that you're available to receive in deduction. They put it on a base deduction layer, and then they added in the second layer of bonus deduction. So the base deduction is a sliding scale from 50 cents a square foot all the way up to $1. And then the bonus deduction, a pretty big leap there, and that's from $2.50 all the way up to $5 a square foot. So as you can see, pretty significant increase in deductions available as long as you hit this bonus deduction amount. So if we go to the next slide, what does this bonus deduction really mean? Bonus deduction, they basically set out two requirements, and the two requirements are they must meet local prevailing wage, and they have to meet an apprenticeship hours up to 15% of labor hours. What does that mean? Well, there really isn't a guidance set forth quite yet from Treasury, and we do expect it to come out sometime soon. However, it's not there. The neat thing about there being no guidance is that what we're expecting is anything that's being constructed currently right now that's planning on being placed in service in 2023 will automatically qualify for the bonus deduction amount. And then again, there's basically a grace period. So once the guidance does come out, there's a 60-day grace period for being able to meet that bonus deduction amount. So good opportunity right now, getting into 179D sector and not sector, but opportunity and any kind of project that's being constructed currently into 2023. Going to the next slide here. The final thing I want to talk about, kind of closing this out today, is fixed asset studies. So a fixed asset study is basically a comprehensive review of all fixed asset holdings that's on a client's or a taxpayer's records. What we do is we basically put on an investigation hat and basically take a deep dive into their all fixed asset holdings and identify opportunities that have been missed over the years. Obviously, we would identify possible cost segregation study opportunities, 179D opportunities, but there's other things as well, all kinds of different kind of methods and accounting procedures that you would take typically for any kind of fixed asset and identifying ways that we could accelerate depreciation or at least correct it and make it into a, an audit-ready book of business. Some typical things we like to see for these fixed asset studies, where it's really helpful for our clients, is if they have more than 25 million in fixed asset holdings, buildings, equipment, and land improvements. One really helpful area or client source that we have is for those clients that are operating out of multiple physical locations, or they have multiple different business units, they have a decentralized accounting team. Obviously, keeping track and keeping everything consistent across all books and all accounting teams is pretty difficult, and so the benefit is really realized pretty heavily in those circumstances. And in most circumstances where we have this type of client, we set up an ongoing engagement where it's yearly or quarterly, and we take basically any kind of additions that are being added each year. We're making sure those are being capitalized correctly. We're setting forth the procedures to do that correctly, so that there is no change and funky things that are here and there and ghost assets that are on their books. Moving to the next slide here, I kind of list out some common causes that we typically see when we look at fixed asset studies, especially in the automotive dealership industry. Things like not claiming any kind of bonus depreciation, right? So you have a bunch of assets on the books and they have any bonus, and they should be eligible for bonus, and that's a great opportunity to accelerate depreciation. 179 elections, right? So expensable 179. Maybe there's a wrong recovery period or incorrect classification of life. Special recovery periods is a big one. Qualified improvement property, qualified leasehold improvement property, qualified retail improvement property. Those are all big opportunities that sometimes are missed because they're so specialized, and it's hard to identify and to know the rules and regulations that are needed to qualify for that type of property and the special treatment of it. And also assets that have never been placed into service. We identify all of those. So to kind of give some real world example as to what we typically are seeing for a single automotive dealership, right? A client just owns a single automotive dealership, a simple fixed asset scrub, going in there and scrubbing through their books and identifying things. We could recognize anywhere to 300,000 adjustments in that first year just by making simple changes in the fixed assets. Now, if the client is a larger client, right, they have dealerships that are all throughout the country, multiple different dealerships and fixed asset holdings. The opportunity there is obviously tenfold, and that is if we look back to all the way, let's just say to 2005 to 2020, some opportunities that we're recognizing is upwards to 4 million in adjustments in that year of accounting change that we make just by doing a fixed asset scrub. And that's, believe that's the last slide I have here, and I think we're going to pass it on to close out this presentation. Thank you all for your time.
Brittany, Brianne, Jonathan, thanks so much for joining us today and for this really great information. This is so helpful come this time of year, and just thank you all again. Everyone on the line, you'll be receiving a copy of this webinar by the end of next week. Join me back here on Tuesday, November 29th, as Dealer Tamer talks 2023 online strategies. For more information about AIADA, visit aiada.org. Thanks for tuning in, and have a great Thanksgiving, everyone.